Welcome to Value Investing webinar. Today we will talk about how to be a successful value investor and the problems therein and how to go about doing it. And with me is Atul Kumar from Quantum Asset Management. Welcome, Atul.
Thank you, Dhirendra. Nice to be here again.
Yeah, thank you. Thank you for being here again. Value investing, there's a whole body of knowledge, 100-year-old, since, Graham and Dodd created this, that it's all about finding the intrinsic value of an asset and your ability and patience to go about buying them below that. And so it sounds pretty simple, but in practice it turns out to be a very tough thing to do. What are the real problems? How do people go about doing it? So that is what Atul is here for. I have a set of questions for him. How to be a more successful value investor. So this sounds very simple, that find the value of an asset, find a realistic value, make your assumptions, and then wait. And and buy it below that. So why investors don't succeed at this when it's that simple?
The first thing which probably comes to my mind is obviously staying the course. So as you say that it's not so much very a short kind of a thing that you do today and you will get the returns tomorrow. Many a times your patience is going to be tested. So you are going to probably have to wait maybe 2 years, maybe 3 years.
Before emotionally it becomes very difficult?
Yeah, to a certain extent for people who are not used to that kind of work where you do not have so much patience. You are seeing that the markets are running up and your stocks are not doing well. Then many a times people may not stay the course. They may think that probably I have got into the wrong stock, and they may be exiting it at the at the bottom or at a time when they should not have exited. So that is one of the things which
could be a test of patience. You see your stuff. What else?
Yeah, apart from that, it is not a very, let us say, exciting job. It's to a certain extent a very boring kind of a work that we do. It's not like something.
Be at it. Keep looking at the facts, revalidating things.
Exactly. Yeah.
Rigorously.
Correct. Okay. That is true. You understand balance sheets. You read them probably after 3-4 years. On a company, you do not get a fully new knowledge, but then you will get an incremental knowledge. So, to be with that, to remain with that kind of this thing, probably for many people, it may not be that exciting, but you are daily reading reports, you are taking notes, you are fine-tuning your, what could be the valuation or what is the kind of price that this could finally get unlocked into. That is one part of it. The other part is also that not many of the companies are also from a company's point of view as well, the companies may not be very exciting. So value investing, you will find maybe companies whose earnings
dull,
growth,
boring company and
correct,
growing steadily, nothing exciting happening, but does the job.
Correct, yeah, okay. That does the job at the right time because they are beaten down. Not much people are looking into that. Probably you are one of the few ones who are
getting excited about
those
getting excited about unexciting things.
Correct, that's right.
So, okay.
Well put.
So, do you think any formal education or some training or some kind of mentoring can actually make somebody a better value investor?
To a certain extent, obviously, as it is.
Of course, besides experience.
Correct, yeah. Experience is the biggest thing over there. Plus, one needs to have the right kind of a mental framework to do that because a lot of the times it will require you to stand a bit against the crowd in the sense that you are backing a company which is not doing well, probably
and the whole market is actually proving that it is not doing well, or is acknowledging that it is not doing well and it won't do well.
Correct, yeah. The whole, as you rightly say, that probably everybody, there is so much negativity at times could be there about that particular company, and you are onto that. So many a times.
Do you think this kind of independent mindedness is what you are referring to? This is possible, because there are people, who You can be an independent minded person, or you may not be. Maybe your training doesn't help. You have to be a born independent minded person, or you can be trained to do that.
I would guess that probably, to a certain extent, I would say that it is a natural thing, as well as it can be acquired through training.
Or experience.
Sitting with the people who have done it. They kind of groom you. They validate what you are. What your thought process is. But at the very same time, it is always important to also go back and check whether the facts you are getting, are they right? So, it's always good to maybe debate with people or somebody else that what is the idea that person has for, difference in opinion. And you can always kind of rationalize yourself to that okay, maybe of the 5 things that are being said, maybe 4 would not count, maybe 1 counts, but that one thing may not be very, very relevant to overall scheme of things.
Okay.
So it is always very important to have an open mind, while it is important very much to be independent in thoughts, but always to be open to, let us say, questioning to make sure that
your own hypothesis about a company.
Correct.
For or against.
Yeah, that is true, because we have seen many of the cases, for example, whether it was as recent as during the financial crisis, that people were betting a lot on a sector, let us say, and probably there were a lot of problems, while the valuations were definitely at a very, very low level. But then there were some kind of problems which an investor should have understood, that what's happening to the fundamentals of the business.
No, but how do you deal with that? Are you referring to the most recent financial crisis or 2008?
I'm talking about, let us say, a 2008 type of
2008.
Situation. Correct.
Yes, 2008, was a mania. But, I was just thinking that, if it is about the recent banking crisis in India, it's very difficult to guess, who is faking the books in a legitimate way. When you look at some of the banks, which actually are some of the NBFCs, which were able to refresh their books. And it is very hard to actually evaluate that how much of it can be a lie, how much of it can be a fiction. They are all NPAs, but they actually don't look like NPAs. So how do you cope with doing such a thing?
Yeah, obviously one is certainly specific
spotting
to
such a problem.
Correct, yeah, specific to some of these type of companies. One has to be when growth rates are very, very high. So if a business is growing at the rate of, let us say, 50-60% per annum, whereas the system itself is growing at a much, much slower pace, then obviously that could be one of the signs where one has to be corrected.
You should be suspicious about such a thing.
Correct, that is true. Okay. Then management incentives in terms of, let us say, what kind of compensation, who's running the business. That also makes a lot of difference, because if in many of the cases they may have a real reason to not let the
make
truth,
up things.
Correct, for things to be made
falsify things.
Correct, okay. Yeah. So those are a few of the things which probably one needs to look into.
You have to look at it from every angle of suspicion.
Correct, yeah. Obviously, in businesses like this, something which is turning out to be growing very, very fast may not be
just to understand, this whole, how you think and how you work, or how you operate in terms of. You would have seen such businesses. You would have evaluated them as an investment avenue, explored that whether it is worth investing or not. At what, how much effort goes into rejecting those ideas?
Yeah, definitely. So,
how many ideas you would have rejected? Did you buy into any of the NBFCs?
In the NBFCs, obviously, post the correction which happened, so we could still find that there were good businesses. Obviously, we had a little bit of doubt about companies who have not seen many cycles. So let us say for the past 5-6 years, the way things were happening for many of the NBFCs, that they were growing very, very fast, and markets were rewarding them by higher price to book. They could raise money at more capital, and then with that capital coming in, their book value was even more enriched, and that led to a kind of a spiraling effect that they could
cycle.
Yeah, correct. Yeah, quote at a much, much higher valuation and those kind of things. But what we found that it's important, our belief is that
you were suspicious of these numbers.
Yeah, in many of the cases, for NBFCs, or many of this thing. To have a long history is important. Somebody who has seen let us say 4 or 5 cycles is much better than somebody who's there just for about maybe about 5 years or 6 years. Also in terms of, let us say, a kind of a business models which are relatively unique, those are
still evolving. They are yet not proven.
Correct, yeah. But some of them, they have been for a very, very long time. So obviously they have a business models which are little different. And some of them could have leadership in their field. For example, there could be a niche area within financing. For example, somebody is financing a particular type of asset only. So in scenarios like this, because there will be a, let us say, a dislocation in the system. Many players are going to get out. Players such as them, they could benefit because they understand how cycles work. They have been careful. Many players going out probably means that they can get better pricing, leads to better kind of yields, as well as, I mean, if they have proven, probably they will get funding still at a reasonable cost, whereas somebody else who's not,
it doesn't get crowded.
So. That's right.
So now give me the mantra. How do you really succeed with value investing? Give me the points.
So for us, discipline is something which is very, very important.
Core.
Correct. Yeah. So I mean, you buy businesses only when they're kind of at a level where you are going to make money. So businesses will,
it must be attractively priced.
Correct. Yeah, that's the most important thing, because then your risk is being captured to a certain extent. I mean, you are not taking aggressive risk. Even if the earnings are going to disappoint, you are not going to be, let us say, I mean, as long as you have done your homework well, you are not going to
bought well.
Yeah,
so
correct.
Buying well is important.
Exactly, yeah, because maybe your earnings could be off by 6 months or 1 year, but then that's fine. That's part of the overall kind of scheme of things. Obviously, the other part is like as compared to any other style, for example, growth style, where in the PE, the focus is on earning growth, which is the denominator. In value investing, the focus is always on the numerator, which is on the price side, that you are always going to buy on the lower side. Similar discipline as compared to buying is also to be exercised at the time of selling as well, because we have seen that markets can get irrational in both the ways. So, I mean, if a stock rises and it comes to the level where it is overpriced, then at that point of time it makes better sense to sell that stock, to look for a better idea, or to stay in cash, because you are risking the money of the investor or the people who have given us money by holding into a stock which could be priced very, very highly. So those could be some of the...
Is there anything special that you do on the value investing angle at Quantum?
So this is what it is. I mean,
just do it rigorously.
Correct. Yeah. I mean, staying with the path in the sense that you follow the discipline, invest in companies which have a good corporate governance, largely in terms of their treatment of minorities. That has to be good.
So you have your checklist, validate and be at it. Wait for your price. Have patience after you have bought it.
Correct.
So it's as simple as this.
Correct, yeah.
Be at it and never violate your own rules.
That's right, yeah. Okay. And with time, discipline. Yeah, correct, exactly. One has to be rigorous in the analysis. The understanding of the business has to be good. How the businesses are evolving, one has to get those things right.
Okay, you have been around for a while. You have been doing this thing only for now nearly 12 years?
Yes, with Quantum, I have been since 2005, so almost 14 years.
14 years.
Correct, yeah.
So value investing, 14 years.
Correct.
So have you seen it evolve in certain way? Has it changed over time, with a lot of new business model coming or the business cycle changing? So do you think any kind of, change in the way you approach things?
Yes, I mean the world is...
The core principle remains the same.
Correct.
Buying something at a reasonable price, or at a, and doing all the, ensuring that your checklist is there, you are not landing with a dud. But after that, what you did in 2005 2004 or what you did in 2009, which was a completely different weather, as compared to 2010 or 15 or 17, which was again a year, a roaring year, and then now, which was which is a very tilted market.
Okay.
So does it change anyway your line of thinking, your approach to doing things?
We are always evaluating that is there something we are missing. So when we come to at many of the times that when we are looking at the stocks which may have missed or that are leading to higher performance, in many of the cases it is rather the multiple re-rating, that not that we have missed on the earning side of those companies, but something which was, let us say, a pricey company gets even more pricey. So that is a challenge which is being faced, that in a world of easy liquidity, value investing does kind of not underperform. We have seen very, very similar kind of a situation that happened in the years.
So all your missed
2006.
opportunities are normally the ones which were very expensive, and they turn out to be even more expensive.
Yes, or in many of the cases we were not very comfortable with holding those particular companies in terms of their treatment of minorities. So one could be that something which is pricey. The other part, the other part is that we are not comfortable holding businesses which do not treat the minorities in a fair kind of a manner. So those are the large kind of issues. But that apart, we always make sure that we are not missing in terms of whether our numbers that we do on those companies in terms of the business, understanding of the business, understanding of the financials, we are right on that. We cross-check those kind of numbers. We go back to history saying that this is what we thought and this is what it came out. So was there a deviation? And what was the reason that led to this kind of
deviation?
If there is a big kind of a deviation, what is leading to that? We make sure that we are covering the adequate amount of companies in that, so that we do not miss out on ideas. So those are the things, and we always kind of go back to look at, if something was not a part of the portfolio, what is the reason it was not, as well as something was a part and it was a drag, what was the reason that it had a drag. So always those kind of things which we are doing in terms of correct.
So thank you very much for your thoughts on this, and now I'm moving to the questions. You are saying that value investing is boring and this and that, but it is actually not so. Earlier we used to invite our viewers to ask question, and this time we have got so many questions only on value investing. Earlier we used to end up with questions on mutual funds. So Anup Lal has this question: how to identify and ignore noise about a company or sector while researching and following a company?
So obviously the focus has to be on the fundamentals, the focus has to be on things that matter. Are the earnings of the business going to grow? Is the company becoming, let us say, a leader in its field, or whatever kind of this thing would be?
Problem cropping up, is it fundamentally going to change things?
Yeah, those kind of things. And sometimes there could be other issues which could be like taking a kind of a headline. For example, it could be that the promoter is selling and he may be selling for certain reason. But probably
promoters pledging has played havoc with companies' stock. How closely you look at that?
In many of the companies, surely we do track
because there could be a great company, and it could be a great company because of a great entrepreneur, and that entrepreneur has actually pledged all his stake for taking a bigger bet, and that bet actually drives out the entrepreneur, and that was the charm of the company. So think of a situation like that, and I'm referring to Z kind of context. But that is something which comes as a surprise. Nothing happens to the company, but the company's stock price takes a big hammering.
Correct.
How do you actually anticipate and preempt such things?
It's very difficult to, let us say, kind of anticipate a situation such as this. But then again, I mean, it can be different from case to case basis. For example, one case, as you say, is that you are taking such a bet that you are risking the main kind of a company. That may not be the true in all the other cases as
It may
well.
not be valid for all.
Exactly, yeah. So there has to be a business which has to be looked in a kind of in a manner which one has to, and there could be certain things happening around that. So one needs to probably segregate from that, but obviously being sure that the business stays on course and at no point of time the minority shareholders, they are being taken for a ride. That would be an important consideration as well.
Yeah, so I would just like to summarize this answer that ignore noise, and how to identify and ignore noise. Anything which is not going to substantially impair the prospect of a company is a noise, because there will be so many announcements, so many news, and particularly the news only about the stock movement on a day-to-day basis itself is a noise. So only if you are actually sensitive to only that news which has a lasting bearing on the company's prospect, that is news. Rest of it is noise. Ignore them. GVV Satyanarayan Raju, he has asked this question: please give us a roadmap on how an individual can start value investing and stay on course with a lot of patience. Please suggest the first few steps that his interest and enthusiasm remain intact in the long term. Before I give this question to you to answer, I would say that first and foremost, make sure that the money that you are going to invest is going to be 5 years and more. Because if your preparedness with that money is not for that term, then the whole process does not start. Then comes, how one should go about doing this.
Correct. Yeah, I would say that you have largely said the most important thing.
Yeah, that's one thing. But rest of the thing, then how to go about doing things.
Correct. Yeah. So one has to look at maybe from a bottoms-up perspective. One has to analyze companies rather than just looking at this is the macro situation and this sector is going to do extremely well, so I put my money into this particular sector. So one has to do a bottoms-up work on a particular company, look at the prospects of various things, and from that basket you choose that what is good, what is not good. You look at in terms of valuations what the company is looking at. You also have to look at that whether that company can grow. So there has to be some kind of, let us say, catalyst for a company, because if a company doesn't have a catalyst, it will remain a value stock forever. So there has to be something which is
turn out to be a trap. So
correct. Yes. Yeah. So there has to be some kind of thing which is unlocking that
something
part
which
of
will change the context and you can benefit from that.
Correct.
Okay.
That's right.
Now here is a scared investor, Chandra. He is asking that, in view of the PMC bank fraud crisis, I am now worried about how much cooperative banks will have wrongdoing cases like this. How many such cooperative banks will have wrongdoing cases like this, and the possible impact of, and can there be such a thing in the banking industry in general?
Okay. So the cooperative banks as a percentage of the share of the banking system, obviously they would be very, very minuscule. And given what the regulator has been doing, the banking system, let us say the scheduled commercial banks, obviously they are a totally different kind of a ball game in terms of their risk management systems, audits internal as well as from the regulator that takes place, the kind of responsibilities are placed on the management. So from on that side, there is very unlikely to be any kind of this thing. But let us say on the cooperative, certainly, some of them,
so unlikely
they could
to
have
be a gross mismanagement of the scale of PMC in a scheduled bank.
Yes, it is. Okay. It is.
That is unlikely.
Not likely, and depositors' money at risk. That is not the case.
Okay.
But many of these cooperative banks, we do not know some of them. But the good thing is that they are still a very, very minuscule part of the system, and it will not spread to the system as a whole.
Vivek is asking, what is the risk return profile of stocks and which analysis tools are used for it? What is the risk return profiling of stocks and which analysis tools are used for it? I think he's looking for a prescription. Is there anything?
Yeah, means obviously, like you buy something which is low, that is how you control your risk. You buy something which is where the management is good in terms of not being unfair to the minority shareholders. You buy with companies which are like not taking excessive risks in terms of debt, etc. And I mean, overall, you are buying at a price which makes you comfortable. I think so. That is how it is. I mean, obviously, one can say that there are other measures of risk control like standard deviation, etc. But from I mean, they do not make so much sense because I mean, stock volatility is not
a measure,
not a risk.
It's not
measure.
a risk as such. Shivraj Kumar is asking that is intrinsic value same as book value? And for example, Coffee Day is trading well below its book value. So should it be considered as a good value pick?
Yes, so again coming back to the same point that one has to look that something is trading at a discount to intrinsic value, but then one has to look at what are the catalysts that are going to unlock it, because when you are looking at it, maybe there should be some clear catalyst over a 2-3 year period that is going to unlock that value. So if those catalysts could be, let us say that the company is reducing their debt, there is a new management which is coming, there could be some asset which was under some kind of a problem that is going to be disposed of, leading to value, or there are some changes in the industry that will lead to growth in the earnings, margins, profitability. So something of that sort has to be there as well, not just that something which it is trading at a discount to its book value.
Okay. Yeah, and I would just like to clarify you, Shivraj Kumar, that book value is the shareholders fund. Equity plus reserve on a per share basis is book value per share, and it does not take into account the company might have huge liability and the book value might still be positive, but that liability can be a huge drag on the earnings and future growth of the book value, because book value rises only if you are able to earn money after paying, if your profits less interest, less depreciation, and the residual actually gets added to the book value after the dividend has been paid, if any. So book value in isolation may not be the only thing. So you have to look things closely. It is not that simple. Now, this is a question from Kasturi Rangan. One can select underpriced stocks, but in India, how can an investor be sure that the promoters are serious about growing the company's business, thereby growing shareholders' wealth? How do you get into the mind of a promoter?
Yeah, I mean, only by maybe with experience, with having a dialogue with them, I mean, understanding their background, that would to a certain extent.
And looking at their own history.
Correct, obviously. Correct.
So, the short answer is that don't buy stories, look at facts, look at evidence. And you have enough history of most companies to look at. Shantanu Marathe has asked this question: are investors at a disadvantage with quite a few companies in India not available for being, as they are not in the public domain to buy? Do you think it is a huge disadvantage to investors? We don't have enough investment avenues?
Yeah, I mean, I would say that this is how the evolvement of the economy takes place. Let us say if you see how the BSE was maybe in the 1980s or as long as 1990s, maybe it was the textile stocks or the cement stocks that formed the major part of it.
No, so, Hindustan Motor, Great Eastern Shipping.
Correct.
So they were part of the Sensex.
Correct. Yeah. So many of them, they have disappeared. Or
in 1990, the public sector disinvestment started. So we didn't have any public sector companies. So we did not have the private telecom sector. So yes, the complexion changes, and I think things will change. But there is still a possibility that a lot of large private companies and some government companies may not be available to investors at large.
Right. I would just like to add that also that I mean, you have seen over a period of time new businesses altogether coming into this thing. So for example, let us say if you look past about 2-3 years, you have had more companies, let us say on the insurance side, on AMC business, on retail side, many of them, they have been coming. Also, there are many businesses where P's have put money, and it's a matter of time that maybe some of the e-commerce companies or different kind of altogether business models, they could come into existence. So, I mean, as the economy evolves, I mean, there will be more and more let us say, listed companies which will list, and that could reflect the kind of activity that is taking place in the economy right now. For example, let us say if 80s was about, let us say, companies such as Hindustan Motors and G Shipping, and after that maybe textile who used to dominate, I think. So it's a matter of time that at different points
it will
of
be
time,
reflection of the economy in general. But let me tell you that last 25-30 years, ever since I've been watching the market, the complexion has changed dramatically. We did not have the technology sector which has come up in the last 20 years, and it's a very prominent part. If you look at the banking sector, the private sector banking industry did not exist. The 4-5 banks which we are referring to, which are the lion part, even State Bank was not publicly traded, it was not listed. So if you look at the complexion of the market, investment avenues are not actually shrinking, they're increasing, and I think they will keep increasing over time. So thank you very much for being here, sharing your insights and answering these questions, Atul. Thank you.
Pleasure to interact with you,
My
Dhiren.
pleasure. Thank you for being with us. Join us again on Value Investing webinar.